Hello and thanks for checking out ChartGuys.com. We're proud to be one of the most successful technical analysis communities online, teaching you the skills to become a more confident, effective, and informed trader. Join our community of hundreds of analysts worldwide working together to learn the charts, generate profit, and achieve financial independence. For access to daily live chart analysis and market coverage, a thriving chat community, along with dozens of hours of exclusive educational materials. We look forward to seeing you. Let's check out some charts. So checking in on the markets, we had an FOMC day today with very little volatility. Why did we not have a reaction? The answer is the market knew what was coming. When the market knows an event in the future, and it wasn't certain, but it was 98% sure. When the market knows an event in the future, it prices it in before the event takes place. That's why you have sell the news events. If you have a run up into a bullish event that the market knows is coming, and then it comes, we sell off when that happens. So this was an instance where the market knew there would be no rate change this time around. And really, we were just looking at the language for what to expect in the future. And all in all, it was an uneventful FOMC reaction. You show me that chart and I would say nothing going on whatsoever. Back when the FOMC reactions were unsure, we would have a 60% chance of a rate cut or 70% chance. That leaves a much wider margin of error in the sense that the market cannot price in a high probability of what's going to happen. So the market has to price in the information as soon as we get it, as opposed to pricing in the information beforehand. So knowing probabilities in markets is very important as far as really incorporating it into the psychological setup. So as soon as we saw a 98% chance of rates unchanged, we knew FOMC probably non-event for today. So at this point, we have a daily bull flag on SPY, and the burden of proof is on the bears to break this support of 312.81 if they're going to prove to us that this is not a bull flag. If we do not break 312.81, the bulls keep their complete control, and we're looking right back at the all-time high. 314.70, 315.18, 31 and 48 are our only little resistances nearby, and we're less than 0.5% from all-time highs. Today, the tech sector was a bit stronger than the financial sector. We'll see that in just a second. IWM trying to be a daily bull flag as well. Little double bottom at 161.94. And again, that level has to clearly break if the bears are going to reject this from being a bull flag. Just 163.08 and 163.41 short-term resistances. So QQQ held on better than XLF today. Bull flag. Bears must break 203.44 to prove anything. And if not, we're looking right back at the high, 205.59, and then the all-time high of 206.05. Again, the bulls are on their path, and it is up to the bears to knock the bulls off of their path to shift any kind of change in the momentum right now. We have the deadline, December 15th. We are going to hear from the president soon as to whether or not these tariffs are going to go through. If they are taken away, the market has already started to price it in because we have gotten some rumors, or I should say some word from China, essentially, that China is expecting, pretty much the video I talked about 2 days ago, if you saw that. But if we have those tariffs stay, the market has not priced that in, and we will see a bearish reaction to that. So that is a news event to be paying attention to for the rest of the week, into the weekend. XLF, we can see it's weaker. It closed near the low of the day. Support is 30.13. If we break 30.13, the daily bull flag will start to go out the window. Still just looking for a daily high or low. It's just a difference between a potential continuation pattern or a potential tightening range pattern, where if we pull back more significantly, no longer a bull flag, then we're looking for the tightening range as opposed to the continuation move. The healthcare sector, daily high or low trying to be established at 99.30. Bulls have to break 175 to see continuation. Bears have to break 100 or make that 99.30 to see any shift in their favor. The biotech sector is starting to shift. Look at the 4-hour time frame. This is a 2-month uptrend on the 4-hour chart. Look at the exponential 12 and 26 period moving average. Since they crossed bullish on October 11th, 2 months ago, they have not crossed bearish. And they haven't yet, but they're starting to close in a little bit. We're starting to potentially lose these moving averages as support. We've lost the 12 period a handful of times on the way up. We've only closed below both of them a couple times, and the bulls very quickly recovered. So you better believe my attention is here now. It's a head and shoulders pattern trying to play out. Left shoulder, head, and we're right at this neckline support, 94.09, 94.05. The low of today is 94.08. If we break 94 tomorrow, the odds of a shift in momentum will increase. Keeping in mind, the bigger picture overall market is certainly important, because if we get this bear break of 94, and if we start to get these signs, first bearish cross of the exponential moving averages in 2 months, first whatever, it doesn't mean anything if the market is not going to see any weakness. What it does mean is if we do see tariffs on for December 15th, and we do see a bearish reaction in the market to that, the biotech bears are starting to position themselves to potentially see some decent follow through if that happens. But we have to see market weakness for the biotech bears to get any follow through on a shift in this 4-hour time frame. So essentially 94 is the first level, and then the next level is 92.79 from there. The VIX, equilibrium, low, high, higher low, lower high, and we're scouting a higher low compared to 1230, closed at the low of the day, holding the low of yesterday, but just barely. And if those levels break tomorrow, we look for the higher low compared to 1230. Gold had a bullish reaction. Why is gold reacting bullish to the FOMC? Because the dollar is acting bearish, reacting bearish. The dollar, daily lower high and lower low. The dollar has broken to the lowest price. There's a clear weekly downtrend now, lower high, lower low. And we are at the lowest price that we've seen on the dollar in 4 months. So support is 97.03. And we're then looking back down at 95.84, 95.74. And the bull and silver and bull miner bulls want to see nothing more than the dollar lose this 2-year monthly uptrend. So starting to see some cracks there. And just a few more levels to take out for these bears, the dollar bears, to get confident, and for the gold and silver bulls to get confident. So we did hold a daily higher low. We're in a daily uptrend for gold. It's just not a strong one. We got the bull break with no follow through. We did form another daily higher low at 1458, and now we must break 1484 to continue this move. Best case scenario for the gold bulls, in my opinion, keep the dollar weak, have Trump keep the tariffs for December 15th, have a bearish market reaction, and have gold make its way back towards 1500. If we reject from 1484 into tomorrow, I'll be watching for a 12-hour equilibrium setup, high, low, lower high, and we would then look for a 12-hour higher low if we do pull back more significantly from here. Silver, anything under 1730 is just a daily lower high, not nearly as close to breaking the recent top as gold. And the bull miners very convincingly setting their daily higher low with these inside bars breaking bullish, and 1484 gold resistance is pretty much lining up with 3025 NUGT resistance. And if NUGT can get this move going with a higher low and then continuation, again, all it will do is increase the odds. We're looking at that probability needle. What is the probability that gold is forming its monthly higher low and that NUGT is giving us a monthly higher low? Let's say right now it's at 40%. If we break the highest price we've seen on this bounce, gold 1484 and NUGT 2530, that needle is going to shift to more likely that our monthly higher lows have been established. Oil inventory report today. V-shaped recovery, bearish reaction, V-shaped recovery, but we're going to be watching for an hourly equilibrium. And hopefully you're catching on to these videos at this point that when we see volatility, we look for equilibriums to be a result. We're looking for a higher low compared to 58.09. Bigger picture, not much of a bearish reaction at all. Anything above 57.68 is a daily higher low. Bulls still keeping control on the daily time frame for oil, and we'll see how this tightening hourly range breaks in the coming day or so. Natural gas, very weak bounce attempt. It's a daily bear flag. Inventory report tomorrow is either going to confirm this bear flag with a drop to a lower low or get this bounce to see a bit more follow through and test the daily exponential 12-period resistance, which rejected the last bounce attempt. That's where we stand as we head into tomorrow. Again, keep an eye out for a headline. We know recently headlines haven't had any substance behind them, but this is a headline that will have substance behind it as far as if we get a definitive what's going to happen on December 15th. If those tariffs go through, China's going to be upset. If they don't, maybe we're closer to a phase 1 trade deal. So hope you're well, do some good things. We'll see you tomorrow.